Last year this time was a hopeful time, with the expectation that 2022 is the beginning of the end of the pandemic. Interest rates were low and everyone expected some growth to boost market returns. There was inflation in the system, but many commentators expected inflation to be transitory. It is disappointing, however, that what we expected and what transpired were very different. 2022 was a long year of macro-dominated events, and 2022 will go down in history as a year of multiple crises. Starting with the COVID-19 pandemic that caused global supply bottlenecks, and as the lockdown restrictions eased, we had the Russian invasion of Ukraine, which added another leg to global inflation that was already high, and China stuck to their zero-COVID policy. As these factors unfolded, there were major ramifications around the world. Inflation spiked to levels last seen 40 years ago, and there was a concerted effort by central banks to rein in inflation by aggressively hiking interest rates. Global economic growth started to come under pressure, and the risk that large economies worldwide will go into recession increased. All these macroeconomic factors had a significant impact on global markets, with risk appetite diminishing. Global equity ended the year down some 18%, and as yields rose during the year, global bonds delivered capital losses, and given that the starting bond yields were already at low levels, they didn't provide the much-needed cushion to keep bond returns in positive territory. We saw the worst global equity and bond returns in many decades, with a typical US 60-40 portfolio experiencing one of the worst drawdowns since the 1930s. In South Africa, we had some protection through the weakening of the rand, which benefits companies with foreign earnings. Even though South African equities and bonds substantially outperformed their global counterparts in 2022, equity returns and bond returns were disappointing and well below their historic averages. Our factor range of portfolios, for the most part, delivered positive absolute returns in 2022. A pleasing outcome, particularly relative to market index composite benchmarks, which in some instances were negative for the year. Our outperformance was largely driven by the healthy 3.8% alpha delivered by our local equity building block, which is particularly welcome in this low return environment. During the year, we recalibrated our long-term strategic asset allocations to take advantage of the increase in allowable offshore investments. We have not yet taken up the full allowable allocation, as we believe South African assets still offer good value. However, we will continue to look for good entry points to increase our offshore allocation. As we step into 2023, there are both risks and opportunities. We have seen a strong start to January 2023, which evidences a key pillar of our investment philosophy, and that is to remain invested and ride out the volatility. One cannot afford to be out of the markets, because missing the strong up days can have a detrimental effect on your long-term outcome. Furthermore, sustainable investing remains a key focus area as we continue to fully integrate ESG in our investment process. Ultimately, the key to investment success is to align your objectives with the portfolio and remain invested. That is what we do at Momentum Investments, because with us, investing is personal.